Hello, everyone. Welcome to today's virtual workshop brought to you by Credit Report. I'm Alicia and I will be your host this afternoon. If you are watching, you can let us know where you are coming from in the chat. You can also start to drop any questions you may have for our speakers today there as well, and we will be monitoring in the chat. We will save the Q&A for the last 5 minutes of the discussion, and we will address some of those questions at that point. Over the next hour, we will dig into shifts in the market, buyer behavior, deal structures, and where to find the deals with some real-world examples. Today, our speakers are Justin Fordham. He is the CEO of Fordham Enterprises. Welcome, Justin. We have Adam Lipkin. He is the Managing Director of Capital Markets at United Capital. Welcome, Adam.
Thank you.
Last but not least, we have Michael Zysman. He is Managing Principal, Founder, and owner of Funding.
Pleasure.
Perfect. We are recording this, and so I will hand it off to you, Justin, to take it away on our topic for today.
Cool. Good afternoon, everyone. Thank you for attending the Credit Report with this webinar. Today's focus will be on navigating a slower market and creating financing in the CRE space. I'd like to welcome and introduce everyone, as they've obviously introduced themselves, Adam and Michael Zysman. Adam, if you want to start off, I would like to talk to you about the deals that we have in motion and where you're currently seeing in today's market.
Yeah, absolutely. So it's great to be with everybody. Just a little extra background. So I've been in the commercial real estate finance space for a couple decades, most of my career in Miami. So very interesting to see just the tremendous growth in the South Florida and just the entire state. So we do quite a bit of business throughout the state of Florida. There's so many markets that are activated at levels that are just like beyond anything that we had hoped for in the past. And it's just amazing to see it, and it's just only going to continue. So I think the big theme is over the last couple of years with the elevated rates, elevated construction costs, everything is just slowed down. That's the whole theme of the of the presentation. A lot of people that were in development sites, they've been sitting in development sites. People that have been in sites for going on 5-6 years are struggling in a lot of cases to continue to keep things alive. I think in a lot of cases you have underlying debt. That underlying debt typically is a year to 2 years max and has extension options that could be 6 months. Those are largely over. Those have been over for the last few years. And so oftentimes what happens is you're seeing a lot of folks that are in development sites have a land loan maybe from 2020 or 21 that then had to get reset with a higher basis to replenish a new interest reserve to then have more life to it. So, it's an interesting time right now in the market where a lot of folks are really struggling to keep their sites longer. Others have been able to bring in partners. Prep has really become where a lot of people are giving themselves like a lifeline. I think a lot of historical LP groups have kind of shifted their focus to say we want a priority, not just be a limited partner. We'd like to be a priority in front of the common. And so you've just seen this industry balloon, hundreds of prep providers engaging in all walks of deals, from construction to transition to permanent and across asset types and across locations. So you've really just seen this unbelievable expansion of prep being offered as a lifeline, for a couple of years. And I think the folks that really believe in their projects and believe that if they could just get through and navigate maybe another year, there's kind of been like a little bit of a resetting of expectations. I think those folks that get that, hey, you have to build now to a yield that's 150 bips wide of where it was 4 years ago.
Yes.
If you can make the numbers work, I think folks are now kind of, okay, if we get the right metrics, we'll move forward, right? I think there was a little bit of a period a year and a half ago where there's still a lot of that uncertainty. And I think uncertainty is worse than when it's in an elevated environment where people just kind of generally have buying that this is just the new norm. You've kind of heard that refrain a lot these days where people are like, higher for longer, right? Rates are going to be this way, that we're not coming back down to these, zero or 25 bips short-term rates and 10-year at 2%, 2.5% anytime soon. It's kind of like people get that, wow, some relief. Maybe if we're lucky, we get under 4, but kind of like being in this low 4s territory is maybe where we're at. So where I'm involved is I have a background doing a lot of specialized financing. A lot of people know me for a product called CPACE. There's a lot of these unique products that are being looked at with a lot more scrutiny to say, how do we work this in to be able to replace maybe more expensive capital? Even just recently, I'm spending a lot of time with the HUD product. A lot of folks maybe never explored HUD and never really saw how beneficial it could be to refinance projects, getting to a little bit of a higher last dollar. And so I find that, if the theme is being creative in the capital stack, usually the way you do that is in collaboration. So I find that typically people have expertise in one of a few areas, usually collaborating with somebody that might have expertise in a complementary area. For example, I bring in oftentimes folks that maybe if CPACE is just a part of the equation, maybe somebody that might help out with a particular need around equity or a particular debt product. And so I think that there's a theme around collaborating. Maybe you represent a borrower, maybe I might represent a certain product or platform. That seems to work really well in this market. Just giving up a little bit of a share of economics for having more of a chance to be able to have a successful execution. I see that a lot.
That sounds like like-minded capital is a term that I've been using for the last year. So it's just finding the right partners and the right capital to infuse into your deal to bring it to fruition. So Michael, if you could give me a little bit of insight on your company and give everyone some insight on what you do.
Yeah, absolutely. So I'm the owner of Citibank Funding. It's a direct bridge lending platform. I started that about 2 years ago. And I started my company, Citibank Capital, which is a commercial mortgage advisory company, about 10 and a half years ago. So been in this space, I guess, over almost 25 years at this point. Like Adam down here in South Florida, in Miami, it's kind of become almost like the center of commercial real estate finance. So it's definitely interesting. I mean, commercial real estate finance has always had a huge presence here, but post COVID, it's really exploded. So
it's really booming.
Definitely, interesting to see. All real estate guys, you kind of walk down this. It's almost like walking down. The boardwalk on Miami Beach is almost like walking down Park Avenue pre-COVID.
Well, with lower taxes, of course, obviously.
Yeah, lower taxes, of course. So,
So I'm sorry, go ahead, Mike.
Yeah, so just like Adam, definitely seeing kind of a slowdown. A lot of it, I feel, is due to kind of slowdown in bank lending in general. A lot of the banks got super aggressive and during the COVID era, and were aggressive pre-COVID as well. And I think a lot of them are dealing with issues from, kind of that period, and they're dealing with that asset management, which, they've historically either, have been kind of the backbone of the commercial real estate finance industry. Now it's really been a shift to kind of private capital and insurance company money. In a sense, I feel like insurance companies have almost become the new banks. To a degree. And then also, there's also a lot of stuff happening in just kind of the private, kind of capital market space with the CLO market, CMBS, and just kind of, large securitized single asset or, multi-asset or just regular CMBS type, transactions. So there's also, I think there's been a little bit of a slowdown in the overall economy. On the bridge side, we've been seeing, kind of NOIs decreasing a little bit. Some asset class, I think most asset classes, some more than others. That being said, I think we've kind of turned more towards looking at kind of price per pound versus just kind of, in place debt yield and so forth. It's really about the business plan, the ability for the market to recover, and what's the basis. I think deals that are struggling with really high bases right now are just going to have a hard time getting things done. It's kind of, people don't expect the market to, skyrocket overnight. It's kind of either kind of going to stay the way it is or, maybe go down a little bit. And if the basis is high, you're less likely for someone to want to kind of, juice up, kind of where they are on that deal, because things go south. It's just makes things a little bit, more difficult. And then also what Adam was saying before about pref equity, yeah, there's definitely a lot of pref equity guys, coming in. That being said, people got to find the right, pref equity groups. It's, from a security standpoint, it's not the best security interest in the world. So it's, it's really, it's very relationship driven, just like, the regular kind of equity, business as well. So, we right now we really like multifamily, construction as well. There's still good markets that aren't overbuilt with great sponsorship. That kind of have a long-term, vision for deals. So, so kind of like we really like the multifamily space right now. We'll look at other asset classes as well, but right now we're kind of we're strongest on multi. So if there's, we'll, like I said, we'll look at, all asset classes, but, we'll dig in and pick the right deals.
Okay. And I like to bring up a good topic that you touched on, which is insurance. How are you guys dealing with insurance as it relates to your region? As I understand, a lot of rates have gone up over the last 2 years. So how are you and your borrowers adjusting to that?
I think it really comes down to the region and why the insurance is high. For example, I was just say South Florida, but the entire state of Florida, people are like, oh, there's increased hurricane risk, increased, flood risk, and there's also a limited amount of insurance companies, right? So it's just kind of like you go back to, economics 101. If there's a few providers, right, and huge demand, the prices go up, right? And
yes,
try to justify the higher prices and this and that. But you really need to have a really good insurance broker that could come in there and explain to the insurance carriers like why this specific property is going to have a limited risk of loss. It could be, if it's in Florida, it could be full concrete construction. It's it's a few feet above a flood zone. There's great irrigation. All the windows are hurricane rated. Worst case, there's a first floor flood, and first floor of most of the units or the building, there's just a couch and some carpet. You're just gonna have to. It's not even covered the deductible, right? There'll be something people are gonna have to pay out of pocket and so forth. So it's really, I think, having a good insurance broker really come in and do their own property inspection report and communicate properly to the insurance carriers to kind of get those costs down, right? And that being said, if it's a stick-built property on the ocean, you're gonna have a hard time convincing anybody of anything. But I'd say probably 95% of buildings in Florida are built to withstand hurricanes, and same thing with the flood systems. I mean, I think 2 years ago there was that big hurricane on the West Coast. It was damaged, but a lot of it was just kind of stuff right on the water, stick built, and then you start going inland, and most of the projects had relatively minimal damage because they're built for that, right? The hurricanes are not a new occurrence, right? They've been here probably thousands of years, and even you look at older buildings in throughout Florida. Even if you go up to St. Augustine, look at some of the earliest buildings are they're solid concrete, and they've been standing for a long time, right? So if they're built right, buildings do well, and you have minimal insurance loss. If they're not built well and they're built cheap, then there's going to be a higher risk, and you're going to have a hard time getting a good policy, right? And then I think a lot of that comes down to is finding a lender willing to accept a lesser, policy. There's some lenders that'll do it, but it becomes sometimes has a higher interest rate attached to it. And and it becomes a circular reference, right? It's like, okay, you're not going to pay the higher premium, but you're going to pay the higher rate.
The higher rate, yeah. And sometimes
let me just add to that.
I'm sorry.
I was going to say just one thing with that too. Michael's point around really having an expert insurance broker, it's so critical because a lot of these questions they could answer. You don't need to know everything. You just sometimes need to have that right person to know what are going to be the insurance requirements for agency compared to a private lender or a credit union or a bank. Where are there ways to be able to maybe get a little flexibility, right? Even just knowing what to underwrite to. A lot of people, it kind of, sometimes you think it's common sense, but a lot of times people are just taking maybe like a seller's insurance and saying, oh, I can just underwrite to it. But it's like, no, there might be different requirements. They might be underinsured relative to where a new lender might be. So I think that's probably the overriding comment that I agree with Michael, is that have a very strong insurance broker that you trust that could talk to where are there areas that you could get some relief and flexibility on insurance. And you might just say, I'll stomach a higher rate. If your business plan is a 2-year plan that you're going to drive rents, whether it be a commercial asset or multifamily, maybe you stomach a higher rate from a private lender that's willing to be more flexible on insurance, right? Maybe willing to do some things that maybe more of a specialty product lender won't do, right? There's government programs that sometimes are very stringent on their requirements. Yes, sometimes there's ways to back off it, but it's a real process. And so you might say, hey, just the speed to move forward and have flexibility on docs and requirements, maybe it's worth having private credit to move forward with something.
Absolutely, and I agree. So as it relates to region, so I'm in the northeastern region. Here at Fordham Enterprises, we're based in New Jersey, and I feel like I'm in the middle of the build, the construction, and also the finance. I say that because when we are building, we primarily build with 3D printed concrete. So I use concrete, we extrude it through a machine to actually build the facility. So when we're building an asset, we're actually building 2 times the speed of traditional builders. And we're also doing that with keeping in mind the actual asset is weatherproof. So it's hurricane proof, fire retardant, pest retardant, you name it. So when people are lending, they actually know that they're lending on a sound project that will be there after a hurricane, if you will. So with dealing with the right vendors, be it your title companies or your insurance companies, you're going to want to work with those people who understand what you're trying to bring to the market, and hopefully they can underwrite to that and not overwrite to it.
Right.
Yeah, I would say in addition to looking at creative financing, there's a lot of strategies to get, to really get into the mix around improving your bottom line income and ultimately your value. So we don't really just look at, hey, how can we finance things a little bit more in an optimal way? It's also, is there a plan towards optimizing your income? Is there a way to drive expenses in a little bit? There's a lot of really incredible technology that's not just pie in the sky that people are starting to bring into the mix and be able to bring efficiencies to how they operate, bring down operating expenses by meaningful levels, 10, 15% or more. It's interesting, Justin, when you're talking about the Northeast, I mean, there's groups that you could put sensors on boilers to bring down heating and cooling costs, 30+%. So I just think you got to get very creative on your business plan and just think about ultimately if the goal is, not just, hey, I need better financing. It's how do I unlock some value in the interim 12 to 24 months? Maybe there's a bridge loan that goes with a business plan that you're already thinking about an element of it, but maybe there's another layer to it that helps you drive income even further, and then ultimately gets you to a higher valuation and ultimately higher financing, maybe within a couple of years. So you got to really be thinking, just again, not just from, hey, what could I finance today? It's what could I finance in 2 years? And maybe your plan started with, I'm gonna start with improving the rents, but in addition to that, maybe there's a lot of people are looking at other income. They're looking at charging stations. They're looking at energy income. There's a lot of just billboard income. I mean, there's a lot of need to think out of just maybe the traditional, hey, I got my rents and leases and that's it. And then really getting more perspective, going out to the market, talking to folks, hey, what else are you seeing out there for ways to drive income? You really got to get out of your comfort zone of the people that you've always been talking to and be willing to hear what other people are doing in similar spaces. If you're in a region, hey, who else is doing this? If you have a commercial asset, kind of look at, what are some other folks that you're aware of that have transacted. But I think that there's a lot of really incredible technology being brought into projects that could really drive value. And so first and foremost, talking to people, start thinking about your project maybe in ways that you hadn't already considered to maybe unlock more value.
I totally agree. I think another way to grow your business would be public-private partnerships. I say that because I just formed one with a university here in New Jersey. And while it was easy to go and build a couple of houses in and around the university to get rental, I actually partnered with the university so that way we can build housing and a facility for them. So it's like you said, thinking outside of the box. I mean, we have a lot of tools that are given to us right now. We have AI that can help to assist with our thinking. So I think a different approach outside of just the margins is going to be necessary to investment. Michael, did you have something to add to that?
I mean, I think, definitely real estate is one of the more entrepreneurial businesses out there. It's, I like to say it's kind of an industry of entrepreneurs, although there's some firms that are getting just kind of massive. It's always about, finding, new efficiencies and new ways of, kind of trimming expenses and pushing revenues, like Adam was saying about, billboard revenue and cell phone revenue and so forth. I think there's definitely always ways to do it. So it's, I think, also trying to find ways through artificial technology as well to trim expenses and push revenues as well. So I feel like kind of AI is probably gonna probably has changed and will continue to change the industry in ways that we probably don't even know yet. I mean, some of us on this might know more than others, but there might be things impacting everyone's businesses from AI that we just we don't know. It's definitely intelligent, right? So
I mean, I'll tell you, with public-private partnerships, just one thing you're just hitting on too. Justin brought up, Michael, you just brought up. I mean, frankly, your real estate taxes are such a massive expense. If you bring in a public-private partnership and you have a nonprofit as the controlling ownership entity, I mean, most states have you get an exemption on your taxes. You typically have to meet some kind of housing guidelines. You want to have some amount of middle income, some kind of mixed income that works. But I mean, one strategy that we find over and over, we're just recommending it because it's this time of year again, but a lot of states have this program. And then even there's the national, just for tax exempt bonds, you need to have 20% of your units under 50% AMI. You could have the rest under market, but you could then open up a world of bond financing if you do have a mixed income project. But Florida is one great example where Florida passed the Live Local Act, it's called SB 102, Senate bill that was passed 3 years ago almost now. But here's a program that basically says, hey, if you set aside a certain amount of units for middle income, this is 80 to 120% AMI, you could see a reduction in your tax bill for each of those units from 100% exemption to 75% exemption. So think about what happens in a lot of these markets in Florida that aren't in these urban dense cores that are probably tougher to hit that number, but in most markets, 120% AMI is in the range of your market rents already. And so you start to incentivize developers to orient their projects with some level of affordability towards that, missing middle. And next thing you know, you could get to a more optimal income that might really help you quite a bit. Now, the challenge with that, just to kind of give you more of a balanced perspective, is you do not have Freddie, Fannie, or HUD yet leaning in on the live local. They're not underwriting to the lower taxes, but there still is a premium when you trade those units. I've talked to a few folks recently that when they've traded their multi and they've sold it with the live local in place with the tax exemption, there is a bit of a premium in the basis that you're trading it for to be able to keep it, because it is real bottom line cash flow that you're getting. I mean, you are picking up more dollars. So I think that's a pretty cutting edge program. I think more states will probably follow suit. You already have a number of local jurisdictions that incentivize for some kind of voluntary missing middle number, whether it's 100% AMI, 80, but you've often seen it at a local level, at the county level. Florida was pretty groundbreaking to do it at the state level. So I would definitely say looking out for more ways to bring in some mixed income. And then also, of course, going back to that public-private partnership route, there's a lot of educational institutions, government buildings that would be very interested in some kind of private partnership to create housing for residents and government employees. So absolutely a strategy to lead in on.
Also senior housing as well. I'm sorry, Mike, go ahead.
Oh yeah. I just wanted to kind of weigh on public-private partnerships. I mean, I think they're key for any real estate, development project. Just historically, it's like you got to build a product that's in need by the community, right? Otherwise, you get resistance, and you just might not have the demand that you want. So you got to build something that fits within the community's need, and if the costs end up being higher, the local community has got to do something to help with either tax abatements or other types of incentives.
It's the number one issue in pretty much every jurisdiction around the country is probably affordability.
Yes.
That's number one or number two in every jurisdiction, safety and affordability. I mean, that's kind of like it. So
every jurisdiction and also every tax bracket.
Right.
Because just because you can afford to buy the property doesn't mean that you can manage everything else that comes along with it. So yeah, that's been an issue.
So just talking to the city about what they need. I mean, sometimes there's these programs already set up that we mentioned. Other times you just speak to your local official and say, what do you want to see? And a lot of times they're willing to work together. I mean, so many projects. I mean, one right now that down here in North Miami, that's how it got started. Developer client basically just sat with the city and was like, what do you want to see more of? And they wanted to see a certain tier of income being addressed, and was able to create some incentives to move forward. And it helps make numbers work. I mean, if you could get some relief on that tax bill, that could have taken a yield of like a 6.25 to a 6.5 or 6 3/4, or so it really is. Absolutely got to lead in on that.
Yeah, I always find it profitable and also better when you go in asking, what do you want, as opposed to saying, hey, look, I just want to build a Walmart here, or I want to build this here. And if you're not in tune with the community, it's just not going to work, because you're just not going to find the right.
I agree. I feel like most developers just should be going that way. Some don't. Then they end up just dealing with resistance the entire time when they could just build something.
And then they wonder why they
the community
permitting and all that other stuff. It kind of just works against you in that regard.
Yeah, and it's amazing if you're building something that the community wants. They'll help you. So
they're going to be the ones to support you. So you might as well be smart, give them what they want, and then maybe you can build what you would like to see around that. But you need an anchor, something to be able to support what it is that you're going to have, especially when you're building an asset that can last anywhere from 30 to 50 years. So shifting into our next question, are you seeing a shift in buyer behavior and as of recently, within the last, I would say, 2 quarters or so?
I definitely have. I think there's a lot of these syndicator guys out there running around raising money. Buying stuff at record valuations with record dollar per unit basis for debt and also value. So I think a lot of those guys are kind of a little bit on the sidelines. That being said, the assets that that generally would trade aren't really trading as much right now. A lot of it because there's a lot of over leverage, and nobody wants to take the loss, right? Lenders don't want to take the loss. The owners don't want to take a loss. The investors don't want to take a loss, and it just seems like there's not a lot of pressure. So it just kind of sits. It's kind of like a perpetual extend and pretend. It looked like they were kind of like, you had that in the global financial crisis, and you had the extend and pretend, and then it looks like they kind of put the brakes on that a little bit. And now it's kind of a little bit of the same thing.
I think the music stopped at this point. Like I think it's been that for the last 3 years. I see so many folks just selling their notes, and you just can't extend anymore. I mean, it's already past that. So I think you're definitely seeing a lot more scrutiny. A lot of lenders have certainly stepped in and said, time's up. It's there's certainly a lot more of that, than 2023. I've definitely noticed a lot more trying to sell note positions, ideally at par, but if not, willing to take some level of discount, back leveraging, getting some kind of note against their note position, just to free up some liquidity. Because think about it, you have these notes outstanding for 2 years. It's like you need to get paid down. If you haven't, like you're not able to lend, right? So
absolutely.
And I'm starting to see the deals that are getting done are deals that have debt at a good basis, and the seller could sell, and there's a buyer for it. But the stuff that's over levered, it's an issue. I mean, even if a lender takes it back, right? Like they gotta sell it for a loss. So it's just it just becomes from a workout perspective, it's I think a lot of it's kind of extended pretend. People are hoping for lower interest rates. I think that's been indicated, and then economy bounces back and rents go up, and you start having continued decrease in inflation, expenses go down, and we'll be more in position to refi into just good long-term stabilized debt.
Yeah, I see refinancing coming back very high for the first quarter for next year. As it relates to buyers in my region, a lot of them are being more cautious, doing a lot more due diligence. Some are still sitting on the sidelines, like Adam said, hoping for the rates to go down, but others are just, getting involved and trying to find creative ways to, get out of whatever situation they're in, or just taking a little bit more time to get into a situation, so that way, they don't end up in a situation where they're being foreclosed on, or they can't, continue the project. But overall, as it relates to the northeastern region, we're kind of running out of space. So everyone is looking into buying either multifamily or doing high density units.
Right.
Yeah.
Yeah.
I was going to say it's interesting. It's the shift in buyer behavior. I think the shift in seller behavior is you've certainly had sellers that have been on the market, didn't get what they wanted, come off the market, come back on the market. I think sellers have certainly gotten more grounded, still slowly happening, but it's definitely playing out over the last couple of years when you're just not seeing the number after a real extended period of time happen. And then there's maybe terms, it could be you get the better part of it. We have some deals that are pretty big development projects where a seller might be taking a note on the back end, right, to be able to get to the better part of some now and some later, right? I think that's starting to play out more and more, where you might just say, I need some number today, and then I could get terms that allow me to get some kind of it still would be in the form of preferred equity. You're typically going to be still ahead of the common, but I think that's more of a deal that's playing out more so now than a couple of years ago. Again, just this extended period of just not being able to put the deal together, I think, has allowed sellers realize, like, hey, we need to do something. So I think sellers have been more willing to make a deal. A lot of buyers have kind of had their number, like, hey, I can't move forward unless I could build to a certain yield, or if I could go into a certain cap rate, knowing where I'm going to drive rents and drive income. Sellers have, after a couple years, 3 years even, of just not being able to move things, I think there's been more of a willingness to be flexible.
Yeah, I tend to agree as well. Also, on the seller end, for those who are in a lower position where their rates are very low, they would be highly reluctant to get out of that to get into something else where the rates are high or even double. Like, I have some notes that are sitting at, let's say, 3 to 4%, and to sell that to get into something higher wouldn't be beneficial to my bottom line. But another tool that sellers are also putting out there as well to get their products off faster would be seller financing. Is that something that you guys see on your end in your region?
Well, that's what we just talked about, right? I mean, so that's essentially what happens. If somebody's going to sell it, they're basically taking back a note, which is usually structured, typically subordinate. I mean, you could have it where that's just your first and it's a seller note, but we're seeing it where somebody is going to have to get some kind of first mortgage. It'll be like a priority position, but then the seller's willing to take some kind of backseat, in the form of preferred equity. That's what I've seen happen in a number of cases for large enough positions. If you have a smaller deal, maybe you might have a seller, they're just the debt. But I've seen it often is there's probably a need for supplemental capital, and that's usually where the seller note could help out, to have that kind of as like a subordinate interest.
Okay.
Yeah, I mean, I haven't seen a lot of that, but yeah, I mean, I could see sellers trying to do that, but it just becomes difficult from a financing perspective. I mean, it's you just kind of like begging from borrowing from Peter to pay Paul type of situation, kicking the can down the road, and just in some ways just kind of increases kind of issues with the deal. And
look, it has to be a deeply subordinate position, right? And so I think under those circumstances, a lender says, okay, there's not an intercreditor, you're not going to be dealing with a lot of additional hooks that could be challenging. And and I think a number of cases you'll have a lender be willing to accommodate it, and they see that the seller note is really taking a position that's pretty deeply subordinated to them. So I guess it depends on the situation. I'm seeing it more for development sites, larger development sites that need to move forward. That could be a way to unlock it, where somebody's sitting on it. They've been, just working through things, and you might have an ability to move forward by having some amount that the seller's willing to take back for paper to get to their ultimate last dollar.
Michael, do you want to add something to that?
Yeah, I mean, I could definitely see what Adam's like saying, but it's if it's an actual kind of sale, I mean that becomes just difficult from a lending perspective because it's just not new cash in the deal, right?
Right.
So I mean, I think if it's something where there's kind of a new partner coming in that wants to just kind of take over the deal as well, that's kind of that's different. But that being said, usually have to come in with some new cash as well. But everything's kind of situational. So there's no it's usually it's not always a kind of just kind of yes or no. Sometimes if there's extenuating circumstances, it makes sense.
It's absolutely the case. I'll tell you. So a lot of people know me for CPACE as a product. I can't tell you how often someone's like, "Hey, could we do CPACE here?" And I'm just like, it's so beyond asking a yes or no.
Right.
It's like, are you financeable? Is your deal financeable? Right? It's like a ton of other questions before could you do CPACE? Right? It's like there's a sequence of when you introduce different products.
Yeah, CP is definitely an interesting product that the CBA Capital brokered some of that stuff, and it was good for some deals. Other deals, it's just not. It's not like So I mean,
what's amazing, like right now, I don't know if you saw this, Justin, Mike, you probably saw this, but two of the biggest CPACE deals to date, massive deals. One was with Two Roads in the Tampa area on their Pendry product. I mean, I think it was like a $290 million CPACE slug, which is massive. I mean, when I got in the industry, I think the whole industry maybe was doing 400 million in 2017 to put that out on one transaction.
Oh, nice.
And then on I think it was a week ago, I want to say it was 170 million with a fund for a condo project in Miami called Domus.
Yeah.
And so those alone, I mean, just to be able to say that there's like almost 500 million of CPACE alone in two transactions, it definitely, a lot of people have reached out, just curious now, like, hey, how can we use it? And it is one of those things where, at the right combined basis, it makes sense to a lot of lenders now in a way that I think they weren't as receptive. And now I think they're seeing it as maybe an alternative to bringing in a participant or, an A note. It's actually, a lot of people look at it as an A note of sorts. It's like a passive A note, it's at this level of taxes, but it has to act like a tax. So, you're seeing that if you're seeing just this unbelievable proliferation of private credit, which is more expensive, and you could come in and maybe replace a portion of that with CPACE, maybe mid-construction. I definitely have seen it more and more as a workout solution. But again, everyone's cherry picking projects. It's a project that you need to do something, and it's going to make sense. And now that becomes a tool to solve, right? But it's absolutely going to continue to be seen. But those were two pretty big headline deals that happened in the last 2 weeks that got a lot of buzz. So
cool. Now I know Fannie and Freddie doesn't really play well with CPACE, but will HUD allow it, or is that
no? You really have to look at CPACE to do like a construction kind of interim project, and then assume it needs to get taken out with some kind of permanent financing. Maybe in the future at some point you're going to have more of a path to do it, but I usually advise people use it as part of a construction project or some kind of repositioning. Picture it being outstanding. Now again, you don't have to pay it off, but in most cases you're going to lose a ton of your most competitive lending options, and even some investors that are just going to say like, we're not going to touch this. So I look at it as part of a business play for construction development, mid-construction recapitalization. You could use it right after you complete construction. In most states, up to 3 years. So I see it as still like bridge CPACE is how I picture it. As much as people tell you, keep it on there. There's by all means, know that it could, but underwrite it knowing that you should get to a basis you get taken out by some kind of permanent lender. You usually want to underwrite to say, what combined basis could I get out of the debt and the CPACE? That's how you want to think about it.
Okay.
Awesome. Yeah, definitely agreed. Yeah, CPACE could definitely be an interesting product. I think if it's going back to Adam saying about the kind of the credit box, if there's a super strong credit box, there's some really amazing use cases for it. You could really kind of in the past, like I pushed it with bank financing to just get like a big CPACE piece and then a big construction loan. But that being said, the sponsors had massive balance sheet, massive bank relationship that ended up being good. And then definitely in the workout space, I think it's it's a good option for a lot of deals that are just having issues, and the borrower and lender can work together. I think sometimes CPACE is great, and then also for hotel space as well. I think it's a good option for hotel deals. So, and also deals that are, quote unquote non-conventional, like not in the kind of the multifamily or office or retail box, right? Stuff outside of that are, that have less financing options, I think.
Oh my God, it's unbelievable. Infrastructure projects. I mean, that's the thing. It's more related to what's eligible stuff, right? So it's any new development's going to have the stuff eligible. So what happens with CPACE is you have just different investor profiles that say, well, we're okay with it for kind of like conventional real estate. Some say we want to do it for data centers or infrastructure. So a lot of people think it's like just like this public funded entity or something. It's just a structure. You have private credit that could say, we'll take something in the form of debt or in the form of CPACE. CPACE is really just the pathway that allows different private capital to know that it's getting paid back, because the structure is such that it gets to attach as an assessment on the tax bill rather than get a mortgage position the way most lenders would take for debt. And so the variety of CPACE providers is just growing and growing. It's not a one size fits all. Some providers don't want to do hotel, or they don't want to do senior housing, or some don't want to do infrastructure, or they can't go above a certain size. So it's important to be able to know who the players are. Not everybody does the same thing. Not everybody has the same term or prepayment flexibility, which is, I think, such a critical factor for what we were talking about before, is you need to be able to get out of it. And so somebody could tell me they have like a great rate, but if they're going to stick me with like some really onerous prepay in year 2 or 3, that's going to end up really hurting my economics. I'd much rather take a little bit of a higher spread, knowing that I could get out more comfortably in year 2.
Right. Yeah. Totally. Yeah. Definitely. Yeah. And I think that's one drawback for the CPACE is just kind of the exit, right? It's like the project, gets built, and now, say there's a 7%, 8% loan with a 25 or 20-year AM. It's being shown as real estate taxes. I mean, it kind of crushes the value, because it's just higher real estate taxes, right? So unless the plan is to pay off the CPACE, you're not going to get credit for that increase in value, or that increase, or the cash flow that's being sucked up by the CPACE. So it's definitely not it's not for every deal. Some deals it's a good product. Others it's just it's not an option.
All right. So I have our final question we're moving on to. So as it relates to opportunities and finding deals, what are you seeing right now in the current lending climate? What are your clients bringing to you, or what are you seeing in your neighboring regions?
It's interesting. I have a long-time client relationship. I love that I'm now using this word, but CPR money is more now needed than ever.
That's a good one.
We're really active in the bridge equity space. A lot of folks that maybe lost their equity partner at the 11th hour, something fell through. I think that, we're kind of in a world now where it's like debt plus what, right? Like debt's, I don't want to say commoditized, because it really does move deals. And so their structure on the debt is huge. But what I like where I'm at, joining up with United Capital, is being able to invest through the capital stack. That was to me very important, to be able to provide that need quickly. That bridge equity, I think, is huge. I had seen some other groups do that really successfully. And then it helps with, I think, the most important part for somebody to just either take down a project that they then have a certain business plan in place, and then you typically are staying with them through the ride, for construction, then ultimate and exit. But I think that's more needed now than ever. Just that bridge equity, and that's coming from private capital. That's all private equity, private credit.
Sure. Cool. Yeah, I'm seeing a lot of interesting opportunities. I mean, for city-based funding, direct lending platform, we lend kind of east of the Mississippi and Texas, and we just don't lend in a lot of West Coast markets. And we're seeing a lot of opportunity, taking out of construction loans that are kind of pre-stabilization. Or need a little time, new acquisitions of multifamily that are being bought at a good basis, and then also ground up construction of multi for the right sponsor and the right market. We're also seeing some opportunity in hotel space as well, although saying earlier, just kind of NOIs across the board have been hit. I think hotels have probably been hit one of the hardest.
Yeah.
But it's expect the economy to be bad forever, then we're all everyone's in a bad spot. But if it's just something that's performed well, and then it's not doing that well right now, and just needs a little little TLC and a little time, and there's a good basis, and good sponsorship, then those hotels, those work as well. So that's kind of what we're seeing. We're also seeing some interesting stuff in retail as well. Deals that had their basis reset. I think retail kind of already went through repricing, and what already went through was apocalypse. And there's deals that weren't great deals, but now they're pretty decent deals because they're at a really, really cheap basis, right? And then the stuff that's really good, it's still performing pretty well. So yeah, I mean, that's kind of what we're seeing. We're seeing some bridge to bridge as well. But so it's really we're seeing opportunity all over the board. And and I think we've definitely seen a pickup since this summer, and hopefully it'll be a strong year for everybody going forward the next 12 plus months.
Hopefully so. For me, from my region, I'm seeing a lot of repurposing. So let's say if we see a school that has now been defunct, we're going to repurpose that, turn it into an apartment building if need be. Your defunct hotels are now condos. Buildings that have been out of use for years have just been repurposed. So it's just finding opportunities where there are none. And like you said as well, like all three of us said, with the public-private partnerships, there've been a lot of areas in and around our towns and tertiary markets that need development. So with going in and looking at the inventory that's already there and seeing what it could be or what it should be, and partnering with local municipalities is where all of the opportunities are for me, and also for the clients that are coming in. I'm getting a lot of outer towners with some pref money that are just, they don't really have to go by a lot of the guidelines that those that need the money that go through the lending process, but they are finding opportunities out there. Data centers are another one, building in and around those areas. We have Abilene, Texas. That's a $500 billion development that's going on there. So they're right in the neighboring towns. There's a lot of development that's coming around. So staying at the forefront of what's to come, be it technology or any new things that are coming to affluent areas. The tertiary markets seem to be an opportunity for building and also lending in those areas. So that's what I'm seeing from my clients and also from my lens in my region. Right. So Alicia, are you joining us back now? I think I see her coming in on.
Yes. Yeah. Perfect. I want to thank the speakers, Justin, Adam, and Michael. You guys were amazing. Your insight is always appreciated. And I know that a lot of the attendees love learning and getting more of that insight into how they can make CRE work for them. So I appreciate it. Thank you guys for being here and taking the time today. I think David is going to take you guys off stage now.
Thank you. It's a pleasure.
I am just going to let you guys know, as attendees and stuff like that, that we really appreciate all of you guys tuning in and checking out what the Crittenden Report has to offer. If you felt like this was helpful, that it brought you guys value, then I would encourage you to look into our premium subscription. With our premium subscription, not only do you get things like this as far as the webinars go, but you are also going to be getting things such as a bi-weekly newsletter that is a PDF download along with access to everything on our website. We have a finance directory with over 2,000 plus CRE contacts that includes lenders and investors, people that are going to help you make the deals that you're wanting to make in the commercial real estate world. And in addition to that, access to our extensive database of past newsletters, premium stories, and past webinars. So as you are trying to dig up information on anything that's happened in the past in the CRE realm, you can find it on crittenden.report.com. So with that, a very exciting thing that we are adding this year to our premium subscription is we are bringing back in-person conferences. It's been something that a lot of people have asked about. Everybody's been wondering when they're coming back, and I want to let everybody know that this coming year in 2026, we are bringing them back, and the first location for this new in-person conference will be in Newport Beach, California. It's where it all started, and it's where we're taking it back to. So Newport Beach, California, I will be sending emails, follow-ups with dates and stuff like that. But if an in-person event is what sounds good to you, the perk that we are offering is that this year, if you sign up for a 12-month subscription premium, you will be getting a free ticket to that conference. So that is a $995 value. It gives you access to lenders and bankers, people that are going to help you make those deals, and you're going to be able to talk to them and meet them in person. All of our conferences, we try to make on a smaller scale, more intimate, so that you can really get the interactions you're looking for. It's not going to be, clogged up thousands of people trying to connect. You're really going to get that intimate in-person touch base with the conference coming up. So that is a $995 value. If that sounds interesting to you at all, if today's webinar gave you the information you needed and you want to learn more, you can absolutely book a demo with me. I will hop on a call with you, no strings attached. It's really simple. I'll walk you through our newsletter. I'll give you a peek into our directory and what we provide there with contact information, and obviously talk to you more about the in-person event. If you book your demo now with me over the next couple of weeks, I'll meet with you guys, and we are doing a special discount for those that are attending this webinar right now. So not only are you getting a huge value savings on the ticket for the in-person event, but you are also saving with additional discount on that 12-month subscription. So we're throwing out tons of savings for those that attended, and we're here today for this webinar. So if you want to take advantage of that, I will drop the link in the chat. You can book a demo with me. Again, no strings attached. We can just chat about how we may be able to help you and how the Crittenden Report might be able to help move some of those needles in the CRE world and what you're doing in your work. So that is all for me. I hope you guys found value in all of this, and that you will join us again. And I hope to see you guys at the live conference as well. That is the end of the webinar. We will be sending out an email follow-up so that you can watch a playback if you would like to revisit any of the topics discussed today. Otherwise, I hope you guys have a great afternoon and a great rest of the workday, and I will see you again. Bye.